Hello, everyone, and welcome to Passive Income Active Wealth Show. I am Bill Fairman, and this is Jonathan Davis. Wendy is taking the day off as half the company recovers from COVID. Our website, and we are an active private lender, hard money loans as well. Our website is carolinahardmoney.com. If you're a borrower, click on the Apply Now tab. If you are an investor looking for passive returns, click on the Investor tab. Don't forget to like, share, subscribe,
hit the bell.
All that great stuff. Depending on the platform that you're viewing us from, you can also ask us questions. We have a chat either on the right side or underneath the screen. So as we get these questions in, we will answer them as we can. We have a great guest today, and we'll get into that in a little bit. Jonathan?
Sir.
I'm going to have, you went away.
Sorry, I'm back.
Scott. Don't take him away. Jonathan is broadcasting from his quality home studio with a left side and right side brain just over his shoulder.
Yeah, right there. You can't really see it, but everyone that walks in here, they look at it and they always laugh because they're like, I wonder what side of the brain you are. Because one of them just says it's like all these charts, graphs, things like that. And then the other side is just, splattered paint. And they're like, I wonder which one you are. So,
well, I look at it and I think it's a Rorschach test. So.
Everything is.
I can't see it that far back.
Bill, when you get over the age of 55, everything is a Rorschach test.
Thank you so much. Folks, we have a wonderful guest, Kris Benson. He is with Reliant Management, and they are in the self-storage business. And you guys know how much we love self-storage. It is recession resistant. I always like to say that as Americans, we are more than willing to spend $100 a month for the next 5 years for $500 worth of crap. And if your crap is really valuable, you'll want it heated and air conditioned as well. I can joke about that because, I have really valuable $500 worth of stuff in a storage facility myself. Kris, thank you so much for joining us.
My pleasure, gentlemen. Good morning.
So you're in the Atlanta area, Roswell, Georgia right now, correct?
You got it. Yeah. Just north of Atlanta, about 20 miles.
And give us a little bit of background on how you got into this industry in the first place.
Yeah, so my story is a little bit unique in that my path was varied. I came from a whole bunch of different backgrounds. So my last real job was in corporate sales. I worked for a company called Intuitive Surgical. Your listeners may know them because of the daVinci robot. It's a pretty incredible piece of technology. And when I was about 30, I made the decision that I needed to do something different. I career-wise was doing great, making money, all the traditional measurements of success I was hitting, but I was miserable. My work-life balance was rough. So real estate was sort of the path for me to create that passive income. And I started like many investors do. We started with some small multifamily in the county that we lived in. And we grew that portfolio until it became unmanageable. And I realized very quickly I hated that as well. We had duplexes, and I think we ended up with 22 units. And that was a nightmare. It wasn't necessarily the managing of the properties. It was more the people. We kind of had like B minus type stuff, and it was just terrible. It was soul sucking is the best way to describe it. So at that point I had heard, and I wish I could remember if I heard it on a podcast or read it, but basically I heard big deals and small deals are the same amount of work. You just make less money on small deals. And so that got me looking at larger multifamily. I mean, I understood that I could create passive income from it. And we ended up selling the portfolio, and long story short, we got into a ground up development for a 64 unit apartment community in a town not too far from where I grew up. And that's really where the light bulbs went off for me as far as starting to understand how commercial real estate worked. And so we invested in a number of multifamily projects as passive investors along the way. About 5 years ago, I started looking at other asset classes just because cap rates and multifamily continued to compress, and even now continue to compress. It's pretty crazy what some of these projects are trading at. It's pretty crazy what's trading in self-storage too. But at the time, there was a spread between what self-storage was trading at and where multifamily was. And so started looking into self-storage first as an investor. And that's how I found Reliant. I was an investor first. And we just built a relationship. The managing partner, Todd Allen, and I just built a relationship. And at one point, he needed help on the investment side and scaling their platform. And so that's what we did. I joined forces with them about 3 years ago as an employee, and we've been growing ever since. And you know, I would say the reasons we went to self-storage, there's really three pillars that I kind of stand on with storage. And you know, you hit the nail right on the head with one of them is, you know, the recession resiliency is pretty incredible. Through the Great Recession, 2007, 8, 9, storage performed very well, lost less than 4% of its value if you look at the REIT performance. And it's happening again with COVID. We're certainly not out of this. We're recording this at the beginning of November, and you know, I think we just broke 100,000 COVID cases in the US, but so far so good in self-storage. You know, people are still paying their rents, and you know, the demand for storage is still there. So it's a nice recession resilient asset class, and historically has performed very well. If you look at the last 25 years of data on the REIT side of things, storage has done just under 17% a year. So when you have that kind of historical performance and that resilience, that's really what drew me to the asset class.
Yeah. So often we hear, oh, go ahead. Oh, I'm sorry, Bill. So often we hear people talking about, you know, toilets and plumbing. And I mean, it seems like no one starts in the self-storage. They all have to feel the pain of the single family, multifamily life. And they're like, man, no plumbing, no electrical. Oh man, this is going to be great. So you have a definitely unique story, but yeah, definitely. I think a lot of people come from that space. You've got to feel the pain before you get to the easier stuff, I guess, is I would say easier, but definitely better.
I think it depends, Jonathan, right on the scale at which you're operating, right? You're replacing one thing for another. So you certainly there's no plumbing, right? You know, we're not going in and replacing hot water tanks in the middle of the night. But storage is interesting in that it's an operational business kind of wrapped with a real estate play, right? Cool. So there's a lot of churn in tenants, at least at the scale we're operating, right? So we have 50 properties across 8 states. You know, it's 30,000 units-ish. And what's happening is tenants have 30-day lease, right? So you're churning a big portion of your tenant base every month. And so there's a business attached to that, right? You know, active marketing, the people behind the desk are moving in, moving out. There's leases going in, there's tenant insurance, there's U-Haul truck rentals. So there's all of that piece, which replaces what you're describing, which is, you know, hey, I'm going to unclog a toilet at midnight. But it's a different business in that there's that operational piece that people don't really think about. Now, there are some people who've automated all of that, right, on the smaller facilities where, you know, they've done some kiosks and there's literally no employees and they just do like a call center. But that's not the model that we're operating on. So you're right. There's definitely some value to how self-storage is set up, but still a lot of moving parts.
Absolutely.
Well, I was going to say that is the beauty of self-storage. It's a business. It's not just real estate, and SBA and banks consider it a business they will lend a higher loan to value on those types of properties because it is a business. SBA, I mean, you can get 95% financing on self-storage if you're using SBA financing. Now, is it a little bit harder to get that type of financing? Not a little bit, a little more onerous, but that works out pretty well in the long run. I also like the space because of the different revenue streams that you can create within that business as well that you're not going to get in multifamily for the most part.
Yeah, you're spot on. There's those ancillary income items that sometimes are a value add play in when we go into a new facility as well, right? I mentioned, U-Haul truck rental, tenant insurance. In some of our pro formas, 10% or so of the income is coming from those ancillary income items. So if an operator is not doing them right now, there's upside for us, right? And many times, if we're going into kind of a mom and pop operated type facility with a value add play, we usually have that opportunity to add those revenue streams.
Are you purchasing and then managing these, or are you partnering with existing businesses as well?
No, we're vertically integrated, so we're buying and managing. Reliance, as I mentioned, we have 50 properties. We probably have about 140 employees. The majority of them are out running the sites. So it's there are third-party management companies that you can absolutely hire to run your facility, just like you could for a duplex that you owned in your town. Some of the REITs, the real estate investment trusts, like Extra Space and CubeSmart, they have third-party platforms as well. So, if you guys went out and developed a self-storage property from the ground up and you guys were developers and said, hey, we'll build this thing out, but we don't want to run it, you can bring in a group like an Extra or Cube to come in and run it. And there's some private ones as well. But at Reliant, we're managing what we're buying.
Excellent. So are you buying existing, or are you doing any developing?
I would say the majority of what we're doing is existing assets. So our sweet spot really has been in the value add space, going into a cash flowing asset and doing something to force NOI appreciation. Sometimes that's putting a shovel in the ground and building out an expansion. Could be not an expansion of self-storage. We have 2 properties right now that we're doing an expansion of covered boat and RV parking. So we still have the storage, but on some of the additional ground space, we're building out some, canopy type parking for boat and RVs. So our value add play really is dependent on that particular opportunity. We do a little ground up development. We were supposed to be in the ground on one this year. But COVID kind of threw a wrench in the municipality approval process, and looks like it's not going to be until next year till we're going to end up with some permits. So I would call us an opportunistic self-storage operator. We don't say, hey, we're a developer. Hey, we only do cash flowing assets. We'll look at almost anything and then make a decision on where we think we can fit it into our portfolio.
Well, that just answered my next question, which was, are you looking for properties that have expansion opportunities and larger parcels of land, or the ability to purchase the land next door, or that type of thing? You're looking at the opportunity, and if it's there, great. If it's not, then you're either going to move on, or you're going to find other ways to increase the revenue or lower the expenses.
Yeah, or we're not going to buy it. I mean, I would say, our acquisitions team is probably looking at 10 to 15 deals a week, and we're probably putting in one a month, or putting an LOI out. And in today's environment right now, we've probably lost 4 deals that we were in the best and final offer. As you guys, I'm sure, are aware, there's a lot of capital chasing deals right now. And so, cap rates are getting compressed, and, Blackstone just bought Simply Self-Storage, a very large 100 property plus self-storage portfolio last week for 1.2 billion, or 2 weeks ago for $1.2 billion. So, it's been validated from some of the larger institutional players as well. So there's a lot of people knocking on doors saying, hey, we want to get into self-storage. And so when you get that, prices go up. Good for sellers, tough for buyers.
Yeah. How do you all source the deals and make sure you maintain a solid pipeline, a closing pipeline with so much competition right now? Are you all doing anything, or do you have some advice for people what they can be doing?
Yeah, I mean, Jonathan, I think we kind of have some unfair advantages there. Reliant's been around long before I got here. So they bought their first property in 2007. And then in 2010, the actual entity was created. So what I would say is we have a lot of relationships in the space, right? So probably similar to you guys, when somebody's looking for a hard money lender, they know about you. Same thing with Reliant. So we have a lot of good broker relationships. Our reputation is sterling in the marketplace. So generally, if we put out an LOI, we're not going to retrade on it, right? So they know if we're interested, we're going to pay the price that we put onto a contract. So unless we find something egregious in the due diligence process. So, we're getting a lot of limited look type deals that a project gets put out to 2 or 3, a broker takes it to their 2 or 3 best clients and says, hey, if you can get to this price, the seller will sell. And we'll underwrite to those. We're doing some active, what I would call bird dogging, or sales cold calling to ownership as well, to see if we can shake a few loose that way to a truly off market deal. So it's all of the above, and then the listed stuff we're looking at too. So we'll, again, if somebody says, hey, do you want to look at it? Our answer usually starts with yes.
Gotcha. What? Because I know you do a lot of more like value add. What is the typical price point or size of the units, the properties that you all are taking down? Are they just kind of across the board, or do you have a particular size and asset type, or I guess size type that you're looking for?
When you say size, you mean just from a square footage standpoint?
Yeah. So units, square footage, however you all run the metrics, is there like something that you're honing in on, or is it just kind of opportunistic, take what comes?
Yeah, I would say that there's a threshold that makes sense for us, right? Because our operating platform is overhead, right? When we put our operations in place, there's a cost to that. So the facility has to be large enough, or the opportunity has to be large enough to support that. I would say for us, generally anything below 30,000 square feet, there has to be a significant expansion opportunity. The average square footage of a self-storage facility in the U.S. is probably around 52,000. So, we're shooting for somewhere in there. Some are larger, some are smaller, but it really depends on the particular opportunity. But generally, I would say most of our facilities or what we're looking at is probably going to be that 30,000 square foot threshold or above, or there's a significant portion of land to potentially develop alongside of it.
I'm sorry, Bill. I just wanted to pick his brain real quick. When you do a value add and you're doing an expansion opportunity, let's say someone's a complete novice, they don't know anything. What is, like, if you're buying a 30,000 square foot facility and you have the space to add another 30,000 square feet, what does that typically cost? How, what does that look like for you guys or for anyone?
I mean, the price per square foot, right, is going to be 100% dependent on the market you're in, right? Mm-hmm. If you're in a big, large primary market, that price per square foot is expensive. It also matters, Jonathan, are you talking about buying the land as the price per square foot as well? I mean, without land, $60-$70 a square foot for a climate control building is probably in the neighborhood. So I think, but that's not to say if you're in a smaller rural area and, maybe you're the contractor or you have a buddy who's a GC that you can build it for a lot cheaper than that. The interesting part, I'm sure you guys have heard about some of the retrofits that go on, like adaptive reuse of some of the retail dark boxes. So, Kmart goes out of business, Toys R Us goes out of business. Those boxes, some of them have been redeveloped into self-storage. And the reason people look to those is because the cost per square foot to redevelop is a lot cheaper than building something out of the ground. The biggest risk in the market right now is new supply coming to market. And so, you just have to be thoughtful of what is the current supply, what's the development pipeline look like before you build that expansion. Because, if you have 3 or 4 facilities in your market that are all in lease up, they're all trying to fill, well, then prices are going to get hammered, right? And everything is going to drop precipitously until people can get that occupancy right. So you just got to be thoughtful of that as you're looking to expand and understand what the demand really is in the market, or do your best to.
Are you typically looking for about a 3 to 5 mile radius around the property is where you're studying the, possible clientele and competition, obviously?
Yeah. So generally, most people would say that 1, 3, and 5 mile radius. Storage is really interesting in that it's a micro market game, right? It doesn't matter what's happening at the, MSA level, right? So if I'm building in Atlanta, or let's say I'm building in Roswell, it doesn't matter that Atlanta is growing, right? It's really the 1, 3, and 5 mile radius around your facility, because if you think about storage, people aren't driving to access storage, right? It's either convenient to work or convenient to home. If it's not in either of those, there's no good school districts. They're not chasing specific amenities. It's a garage. So, people are going to basically do what's convenient for them. So when we look at a market, what we're trying to understand is that story in the 1, 3, and 5 mile radius around the facility. One of the things our acquisitions team does when we get a property under contract is we map every tenant in the facility. So if there's 500 units and they're full, we'll get a map that shows the addresses of all 500 tenants. And then you can understand what is the market that you're servicing. Well, what it also helps is where is your risk if new development comes in, because you generally know where the opportunity is for new development, right? You're on a main thoroughfare, you're looking for traffic count. So if there's a whole bunch of open land in a specific area and all your tenants are coming from there, you may say to yourself, well, that's a risk for new development coming in, because if somebody parks one right here, that's going to take all those people and keep them there, right? They're not going to drive past a facility to come to us. So that's our story. Our acquisitions team talks about building the story for the marketplace, and that's really what we try to do, is understand demographic on paper, the 1, 3, and 5, but then also what's actually happening within that market.
Well, I know you mentioned you're in 8 states. What are the MSAs that you guys are kind of focusing on?
You want all of them?
Just a general
top 5.
Yeah, just a general idea of the area. That's all.
I'll give you high level. I mean, generally we're chasing secondary and tertiary markets in those markets. So the last 2 properties we bought, one was in Wilmington, North Carolina, which I would say is, probably a really small secondary market or an okay tertiary market. And there's no really hard and fast rules on what's secondary and what's tertiary. But, for us, we feel like that's where the consolidation and the yield still is, because there's been a huge development cycle in self-storage, mostly in the top 25, 50 markets in the country, right? So you think about your gateway cities, New York, Dallas, LA, Atlanta, there's been significant development across the board there. So, we're always looking for the market where we feel like we're in the path of progress, or it has its own unique story. Like the second property that we closed in the end of August is in a town called East Denali, Georgia. And I live here and I don't know where it was. It's right on the border of Georgia and South Carolina. Small town, it would never show up on anybody's radar, but it's right on Lake Hartwell, right? So there's a whole bunch of recreational activity that gets pushed through there. And the value add that we're building there is not storage, it's boat and RV parking. So this owner it was his only facility and he just never built it. And, the demand is there, but they just never built any of the pavilion style parking. And so with that amount of traffic coming off Lake Hartwell, which is one of the biggest freshwater lakes here in the Southeast, it provides an opportunity for some NOI growth there. So, that market level, I would say, think secondary and tertiary markets, because that's, the second part of it is then you're not competing with the REITs. You don't have a public storage and an extra space and a CubeSmart right down the road where, if we go into Atlanta, they're going to be everywhere we are generally.
Well, you also have to look at how the demographics are changing with COVID. you have an opportunity now for a lot of people can work out of their home. And a lot of people are moving away from the gateway cities because of the expense of living there, and that they can go into those secondary and tertiary markets, have a lot lower expense to live there and still be able to earn the same money because they're still working for the same companies. They just happen to be working out of their homes now. And I think that's a good opportunity for you, because those markets are going to continue to grow as people expand out of those bigger, more expensive MSAs, and you're able to pick up properties at a lower price because the cost of land hadn't gotten up yet. Now, with everybody moving, it may, but at least you're in growing markets.
Yeah, we'll see, right? I mean, pendulum has shifted or is shifting in one direction today. I'm kind of a believer that anytime the pendulum's pushing one direction, eventually it's going to swing back. And, cities like New York City, it'll come back, right? I mean, it's a question of when, and there's going to be some pain in the short term. There's no doubt about it. But, the draw of what makes a big metroplex will return. And, how people consume office space and those types of things certainly will be interesting to see how it plays out. But you're right. Right now, there's this push to the suburbs, or even tertiary markets, because people have the flexibility to work anywhere, and we're certainly going to benefit that. I think everybody's seeing that trend, as well as just the normal population trends. Right, people are usually leaving the Northeast and coming into the Southeast. Right, people accessing sun, lower tax basis, et cetera. So yeah, all of those factors kind of help us decide, all right, is this a market we can see a reason to be in?
Yeah,
sure.
And I understand you all have a fund. You all are you all actively taking investors into your fund? Is it closed? What does that look like?
Yeah, so Jonathan, we're raising capital in a vehicle. It's called Reliant Self-Storage Fund 2, and the best way to think about it is mutual fund of self-storage properties. So we'll build a portfolio of properties, and the performance to investors will be based off the performance of that portfolio. So it is still open. Those two properties I just mentioned, one in East Denali and one in Wilmington, those are the first two that went into it. There's a third closing in the beginning of January, and then we have a number of LOIs out. Maybe we get none of them based on the way the market is right now. But the goal is to build out a $50 million equity fund, probably somewhere close to 7 to 10 properties. And then we'll close it in summer of 2021 is the plan right now.
Scott, can you throw up their website just so is this the best website to go to reach you guys and to inquire about getting into the fund is what is it?
ReliantInvestments.com is probably the best opportunity to learn more. There's an Our Investments tab at the top, and that'll get you more information on the fund. You can download the investment summary. There's a webinar, due diligence documents, and then certainly if you're interested in learning more, you can set up a call with us.
Gotcha. There's no hyphen, Scott. It's just Reliant Investments, no hyphen.
Yeah,
there you go.
Kris, is the fund open-ended, closed-ended, evergreen? How does that operate?
It's closed-ended. So we'll close it once we have the properties in place. And then ostensibly you're in it until we sell it. So, we project it to be a 6-year hold. And if we're selling properties along the way, we can't add them back in, right? So it's just that particular portfolio of properties. And as we sell them until we sell the last one, and then that fund would be closed.
Yeah.
So one of the benefits of investing in a fund that holds properties is that you can get tax benefits to offset your gains. You want to talk a little bit about that?
Yeah, for sure. I think that's one of the big differences between, just investing in a REIT and a publicly traded REIT and a privately placed fund is you earn your pro rata share of the depreciation. And for your listeners who may not be, familiar with how depreciation works, ostensibly the IRS allows you to write off a loss each year you own the property, because they assume that everything on the property is worth less next year than it is today. So, you know, my roof's a year older, the siding's a year older, all my fixtures. And so they allow you to offset some of that loss. And the upside to it is, as you had mentioned, that you can offset the income that you're earning from the property. So, you know, generally for most of our properties in the early years of the fund and individual properties, your K1, so what you would get from us, even if you were earning a return, is going to be negative. We try to do cost segregation studies on our more stabilized assets so that we can front load some of that depreciation and maximize the tax efficiencies. But for your listeners who are, you know, generally interested in real estate, probably familiar with depreciation, and this just allows you to get your pro rata share of it through the fund.
Gotcha. And so most of our listeners may not be aware of cost segregation studies either. Can you kind of tell them what that is and how that plays into the depreciation?
Yeah, for sure. So most commercial real estate is depreciated across the 37-year schedule. So literally, if you just took 1/37th of the value of the property each year over 37 years, at the end of that 37 years, your property to the IRS is worth $0. So what cost seg does is ostensibly allows you to take items that depreciate faster than 37 years. And, you know, it's a complex, the list isn't complex, but how you do it is complex. There's engineering firms that focus, they'll come out to your site and ostensibly value how much, you know, your landscaping value lost this year. And you can front load some of that depreciation. So instead of a 37.5-year schedule, it's 5 years. So if you're going to own the property in a short term, it may not make sense to do that, but you can offset more income based off how cost seg works. You know, the thing to think about though, for many investors, if they have a W-2 job, you're not offsetting W-2 income with K1 passive losses, right? So a K1 is basically a W-2 for an LLC. So if you're in a partnership with somebody at the end of the year, you may get a K1 that reflects any income or losses from that partnership. Well, if I have a day job, let's say I'm a doctor and I make, I don't know, 500 grand a year, I make $250,000 a year, whatever it is, I'm not offsetting my W-2 income with K1 income, right? So if I show a $100,000 loss on K1, it's not like I deduct that from my 250. And look, I'm not a tax professional, so everyone listening should talk to their own tax preparer, yes. But just so people understand, because some people come to us and like, well, this is great. Just show me a lot of losses because I need to offset all this W-2 income. And that's not how it works. So, you know, you can offset other K1 gains and again, confer with your tax professional. But generally people like real estate because of the ability to offset the income it produces on its own.
So basically at the end of the term, you're going to get a capital gain.
Mm-hmm.
So those losses that you would be accumulating over time are really going to offset the taxes you're going to have to pay on the gain when the property does sell. If you had no other K1 income, correct? It
could, but you have to also understand, not to get too far in the weeds with this, but whatever you're depreciating, you're going to the IRS is going to catch it up.
Right.
So when you sell that property, whatever your basis is, right? And if you've written, let's say you bought a property for $100 and you depreciated it down to $75. Well, the IRS, when you sell it, let's say you sell it for $200, now the IRS, instead of a profit of $100, what you originally paid versus what you sold it for, you depreciated to 75. So the profit's $125 to the IRS.
Right.
So they're going to catch you up and say, hey, your profit's more than you started with. So that's the downside. And there's some more sophisticated strategies that many really wealthy investors do. It's called a 1031 exchange, which defers your taxes, and you can actually roll over your gains into another property with no taxable event. So that $125 that I just talked about of profit, you can roll that into the next property and pay no tax on your gain. And the strategy is called defer, and die. So you just keep rolling keep rolling, and then you die, it passes to your estate and you never pay tax on the gain, and your depreciation clock steps up in basis, it restarts. So, people get upset that, Donald Trump hasn't paid taxes. And, it's because his businesses show so many losses. Well, I haven't looked at Donald Trump's tax returns, nor do I choose to, but there's probably a lot of depreciation in there that he's showing on his properties that's offsetting his income.
Yeah.
I like that. You pass on your capital gains to your heirs. I'm just kidding.
Well, if you do it right, they don't ever have to pay it.
Right, because it resets.
That's the upside.
You pass away. So is there I'm assuming you have to be an accredited investor to get into your fund?
We do. So our particular vehicle is a Reg D. It's called a 506C offering, which means all the investors have to be accredited and verified to do so. As part of the process for us, investors, verify through a third-party service called verifyinvestor.com. So it's submit tax returns or a brokered statement, something that proves net worth.
Yeah, one of the benefits of this year is that the SEC has widened the guidelines for accredited investors. So they're allowing a few more folks in there that didn't quite meet the income or the net worth box that you had to check. Scott was asking a question about the usual rate of return. We're not going to ask that because you have to be an accredited investor to find out. But we can ask, is there a minimum amount to get in?
Yeah, so in Fund 2, the minimum investment is $50,000 of either cash, or we do self-qualified funds. So a lot of our investors use self-directed IRA or self-directed 401ks to invest in that vehicle.
Listen, there's a lot of people in private placements using their self-directed IRA. And it's a shame there's only about 5% of the population that even utilizes or knows anything about self-directed IRAs.
That's because the brokerage houses don't make any money on them. There's no assets under management fee to charge when people do self-directed funds. So it really is, and I personally have one. It's an interesting way. If you're not familiar, Google it. It's an interesting way to deploy retirement funds in some alternative investment strategies than your general equities based platforms.
Well, I obviously I'm biased because I'm in the real estate business, but I love investing in real estate because you're actually investing in a tangible asset, not the promise of a company that is going to make a profit. And we're more based because we are a lender. We're based more in the single family, residential, small multifamily. We lend on some small self-storage as well, but again, smallish.
Ours are going to be definitely under 3 million.
Yeah. And that said, that investment is really a hedge against itself. You've got income producing properties. The single family that we're doing are typically going to be sold when the project is complete. But I don't know. I always like to compare it to the gold salesman who says that, gold has never been worth zero. That's true, but you can't rent your gold out. How are you going to make any money with that? And another saying that I love is the house doesn't care what it's worth. You're only concerned about the cash flow. So if, your value goes down, who cares? As long as it's cash flowing. And if the value goes up too much, then it's time for you to sell it and get two of them that are cash flowing.
I think one of the best hedges in the market is debt-free single-family housing, right? It's always going to have demand. It may not, the values may go up and down, right? And that cash flow amount may change. But if you have the ability to be debt-free, you can't lose money, right? If you're in it for the long haul. And another quote that I love is everything's a good deal in 20 years, right? If you think back, and I can certainly think back in my career, what stuff was worth 20 years ago versus what it's worth today, there's no question, right?
I forget where I was. There was this guy, and he's written a few books, and he does the single family game, and he's kind of famous for saying, I got into this like 20, 30 years ago, and the first house I bought, I paid too much money for, and it's the best asset that I have. Yeah.
Yeah, because you've had it for that long. I do differ with you a bit, Kris, on the leverage component of the single family. If you can get conventional financing still, and if you're doing this, you're doing it in your own name, not as a business, but you can get up to 10 loans or 10 mortgages conventionally. You're paying as low as the rates are right now, and you can get them fixed for 30 years as long as you don't over leverage those properties. If you can keep them at, say, 70% of market value or under, and you're paying 20 years from now, you're paying with today's dollar, which we know that's going to be worth a whole lot less. That's a great hedge as well.
Fair. It's all kind of, you're 100% correct, especially in today's environment where interest rates are, the cost of debt is ungodly low. But it's an interesting, we get it. It's always a part and parcel of a portfolio, right? And I would suggest to no one that you should invest solely in self-storage. Although if you looked at my portfolio, I'm pretty overweighted in self-storage, but it's all just, a piece and a parcel. And, it depends. I have a few friends who look for kind of that, what is the safest thing I can do? Right. And look, debt adds risk, right? No matter how good the terms are, at some point it's adding a risk to you. So obviously the lower leverage you can put on, the less risk there is attached to it. So yeah, you and I are correct. I kind of look at everything. This is me personally, is if it's 5% or less, I'm using somebody else's money, because I can almost guarantee I can take my money and go get better than 5%. So
exactly.
In today's environment where interest rates are, there's almost nothing I'll buy with cash. I mean, it just doesn't make any sense.
On the other side of that, there's something to be said for being able to sleep at night knowing that the only way you're going to lose it is if you can't pay the taxes or the insurance.
Fair. I think we're arguing out of both sides of our mouths at this point.
Yeah. I think the key there is make sure that you're paying very little for the money and that you're not over leveraging. That's where a lot of people got in trouble in 07, 08, where they were highly leveraged on these properties. And a lot of people were buying rental portfolios not for the cash flow. They were buying it for for the appreciation, which is absolutely the wrong thing to do. You might as well go to Las Vegas.
Yeah, that'll get you in trouble real quick.
That's right.
It's interesting. I read a report this morning. Sorry, I didn't mean to interrupt. Right. But a comparison between the great the 2007, 8, and 9 downturn versus what's happening in today's marketplace, specifically with CMBS and the defaults in commercial mortgage-backed securities. And what I did not realize was that the peak of CMBS from 2007, 8, and 9 was 2012. So the banks held on for almost 3 years before they started to basically release the blood in the streets, right? Where they said, okay, we can't hang on to these assets anymore. And borrowers as well. And here, what's interesting is it's happened so quickly, especially for retail and hospitality. The amount of borrowers who are starting to just push properties back is happening very quickly, where they're just saying, look, there's no way. Like, I owe 2.5 times what this property is worth right now. I'm never going to get this back. You can take it, Mr. Bank. And it's just that CMBS is built, or the default is building up much quicker than it did in the last downturn. So we'll see what happens long term, but it's certainly a different type of event this time around with COVID-19.
For sure.
Well, hopefully, on the other end, it's an opportunity for investors that can come in and then reposition those properties, redevelop them into something that makes more sense for the current time. There's still definitely a need for affordable housing, and there's a lot of hospitality properties that could easily be converted to that. Now, there are going to be people that are going to take it in the shorts. Don't get me wrong, but that's always opportunities for other investors to come in and profit from it. But that's kind of how the cycles work, right?
Yep.
No question.
All right, Kris, it was great having you on.
Very enlightening. Thank you.
Awesome information. Love your business model. Like I said, we are big fans of self-storage, always have been.
And I found where that street was that you said that owned in our town here. So yeah, I drive by it every time I go to the lake.
There you go.
No idea what the name of the road was he was on. He doesn't look at street signs, apparently.
Well, it's just one of those off roads off of the main thoroughfare. So it's you don't pay attention to it, but it's right there off a main road.
So before we go, it's ReliantInvestments.com if you're interested in investing in your fund.
Yeah, you can definitely reach out to us through that. I'm fairly active on LinkedIn as well. It's Kris Benson with a K. People can reach out to us that way as well. But between the two, you'll find it.
Excellent. Well, good. We got Scott just put the URL up for us. Kris, again, you were an awesome guest. Thank you so much. Folks, we're going to wrap this one up. Thank you so much for joining us for Passive Income Active Wealth Show. Our website is carolinahardmoney.com. If you're a borrower interested in borrowing some money, then click on the Apply Now tab. If you're an investor looking for passive returns, click on the Investor tab. Don't forget to like, share, subscribe, and hit the bell. It's been a great day. I only coughed twice. We'll talk to you next week. Thanks.